Hey everyone, welcome back to Corporate Decoder, where we break down the confusing world of business and finance. And when it comes to Windtree Therapeutics, it looks like their time on a major stock exchange is coming to a close. So let's decode what that means. Windtree Therapeutics is in the news for a pretty significant reason. It seems they've been notified by the Nasdaq stock market that their common stock is going to be delisted. This means their shares will no longer be traded on the Nasdaq capital market. The primary reason for this delisting, as stated in the filing, is a failure to meet a specific Nasdaq listing rule, Rule 555F2. While the filing doesn't go into the nitty-gritty of what that specific rule is, typically these rules relate to things like maintaining a minimum bid price for your stock or meeting certain financial health requirements. For Windtree Therapeutics, it sounds like they weren't able to keep their stock price above a certain threshold, or perhaps they didn't meet other financial benchmarks 2025. Now, this isn't the end of the road for their stock, but it is a shift to a different kind of market. The company expects its shares to start trading on the over-the-counter or OTC market. For those unfamiliar, the OTC ID tier, which is a specific segment of the OTC market, however, they do caution that there's no guarantee they'll be approved for trading on this specific tier. It's important to note what the company is saying about this transition. They are asserting that this move to the OTC market will not impact their actual business operations. This means that the research and development, the management team, and whatever products or services they offer will continue as usual. They also reassure investors that they will still be filing all their required reports with the Securities and Exchange Commission or SEC, making important company information available to the public, which is a good sign that they're trying to maintain transparency even through this change. The company, like many others, is providing a forward-looking statement, which is essentially a common practice in these filings. They're talking about their anticipation of trading on the OTC ID tier. This is a standard disclaimer that they are making a prediction about the future, and like all predictions, it's not a guarantee. They're also pointing to other filings like their annual report on Form 10K and their quarterly 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 report on Form 110Q as sources for more detailed information, particularly regarding the risks they face. They're essentially saying, hey, things are uncertain and you should look at our past filings for the full picture of our challenges. This is a crucial part of disclosure, encouraging a deeper dive into the company's situation. And as usual, these reports are signed off by the company's leadership. In this case, the report is signed by Jed Latkin, who holds the title of President and Chief Executive Officer. This signifies that the company's top executive is aware of and attests to the accuracy of the information in this filing. Now let's talk about what this delisting means for investors and the company's future. Being delisted from a major exchange like Nasdaq is generally not a positive event. It can signal financial struggles or a failure to meet the standards expected by these exchanges. For investors, it can mean a few things. Firstly, the stock might become less liquid, meaning it's harder to buy, as despite being on the OTC, they might eventually regain a listing on a major exchange or maintain a stable presence in the OTC market can make the stock appear riskier and less reputable. However, the company's statement that business operations will remain unaffected is key. If they can continue their work and show progress despite being on the OTC, they might eventually regain a listing on a major exchange or maintain a stable presence in the OTC market can make the stock appear riskier and less reputable. However, the company's statement that business operations will remain unaffected is key. If they can continue their work and show progress despite being on the OTC, they might eventually regain a listing on a major exchange or maintain a stable presence in the OTC market and make the FSTA for may eventually regain. The reason for the delisting, the non-compliance with Nasdaq listing rule 5055 to do is the crux of the matter. While the exact rule isn't detailed here, the common culprits are usually related to market capitalization, bid price, or public float requirements. For a biotech or therapeutics company like Windtree, which is often in a high-risk, high-reward phase, maintaining a stable stock price can be challenging, especially if there are delays in clinical trials, funding issues, or the market isn't reacting positively to their research and development pipeline. Investors look for companies that can demonstrate consistent financial health or a clear path to profitability. And if Windtree isn't hitting those marks according to Nasdaq-specific criteria, this consequence is a natural outcome. What's interesting here is the company's proactive approach to communicate this. By issuing an 8K, they're informing the public immediately about this significant development. This transparency is vital, especially when moving to a less prominent market. The hope is that by continuing to operate and report diligently, they can rebuild trust and signal that this is a temporary setback rather than a fundamental collapse. Looking at the broader picture for Windtree Therapeutics, if we consider their business model, biotech companies often burn through cash during their research and development phases. They rely on funding through stock offerings, partnerships, or venture capital. If the stock price falls too low, it becomes very difficult to raise additional capital through equity financing. This could create a vicious cycle where a low stock price leads to funding difficulties, which in turn further impacts the stock price and business operations. The move to the OTC market might be a way to continue operations while they try to stabilize their financial position and achieve milestones that would allow them to relist. The cautionary statement regarding forward-looking statements is also something to pay attention to. Companies include these to protect themselves legally when they make predictions about the future, when they say they cannot guarantee future results and have no obligation to update or revise their statements. It's a signal to investors to be cautious and do their own homework, rather than relying solely on the company's optimistic outlook. It highlights the inherent uncertainty in business, particularly in sectors like biotechnology, where success often hinges on scientific breakthroughs and regulatory approvals that are hard to predict. Overall, this filing tells a story of a company facing a significant regulatory hurdle, leading to a transition to a less prestigious trading platform. For Windtree Therapeutics, the immediate future will be about demonstrating stability and progress on the OTC market, hoping to attract investors who are willing to take on the higher risk associated with such a trading environment and companies in this phase of development. The lack of specific financial figures in this particular 8K filing means that for a deeper financial analysis, we'd have to refer to their most recent 10Q or 10K reports, which would provide the revenue, expenses, cash flow, and balance sheet details necessary to understand the underlying reasons for their trading status. Without those numbers, our assessment remains focused on the strategic and market implications of this delisting event. Now, looking at this situation broadly, Windtree Therapeutics seems to be navigating a very common but challenging phase for many biotech firms. They're facing immediate pressure from a major exchange's listing requirements, and the move to the OTC market is a clear sign of that pressure. This isn't necessarily a death knell, but it does present adoption challenges. The main strength here is their commitment to continuing operations and their transparency. However, the weakness is undeniable. Failure to meet listing standards. The key risk is their ability to secure funding and maintain investor confidence while operating on a less prominent exchange. The opportunity lies in using this period to execute their business plan, achieve critical milestones, and potentially relist on a major exchange in the future. So, in conclusion, Windtree Therapeutics is moving from the Nasdaq to the OTC market due to listing rule non-compliance. While they aim to keep business operations as usual, this is a significant setback that could affect liquidity and investor perception. Their ability to execute their strategy and communicate effectively will be crucial for their future. Alright, that's our breakdown of Windtree Therapeutics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more insights and discussions. Thanks for watching. See you next time.